Hello and a warm welcome to another edition of Econoday Unplugged. It's Tuesday, the 15th November 2022. Terry Sheehan's on the US East Coast, Max Sarto's in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London, where disappointingly reaction in the financial markets to England's victory in Sunday's World T20 Cricket Cup final has been rather less bullish than I'd have hoped. Anyway, moving on. If there was a message from the financial markets last week, it was to never underestimate the importance of inflation. As the saying goes, one swallow, or in this case, the US October CPI, might not make a summer, but the huge reaction in the currency, bond, and stock markets to Thursday's surprisingly weak report suggests that investors are certainly hoping that it will. So, in today's podcast, we'll update the regional economic picture as usual, but with a particular focus on prospective inflation trends. So, as usual, let's kick off with Terry. So, Terry, last Thursday, US stocks saw their strongest day in more than, 2.5 years? Treasury yields nosedived, and the dollar index posted its largest one-day loss since March 2009. And it was all triggered by unexpectedly low inflation, it seems. So, straight to the big question. Are investors getting carried away, or is there enough in the data to suggest that inflation really might now be on its way down?
With 1 month's worth of data, it's hard to tell. But this morning we got our producer price index here in the US, and we saw a similar thing. It came in well below expectations. While there are not signs of massive improvements, it's sufficient to grab your attention. So it looks like a lot of the increase in October was energy, not surprisingly. And outside of that, we saw some broad-based easing up of upward price pressures. So it was a pretty good report.
Now, it's got to be said, if I remember rightly, and you'll correct me on this, that we've seen the market effectively underestimating inflation in, a number of the last several weeks, both in terms of the headline and the core data. So, I mean, do you think it is just a case that given the kind of white noise we get in the individual monthly statistics, that you wouldn't really attach too much weight to this particular report? Or are you actually starting to move into the camp whereby, well, look, with a bit of luck now, we have actually peaked out on not so much perhaps on the headline rate, but really what's going on with the core?
And yeah, I'm moving in that direction. Uh, there's enough signs here that Fed rate hikes have really begun to cut into demand, which is what they're designed to do. And so we're seeing some broader decreases. And the one place we're seeing some of these decreases are in the services, where the upward pressure has been steadiest. We've had quite a bit of volatility in food and energy, of course. But it really looks like some of the underlying drivers of prices are getting better.
Okay. October employment report was strong.
Yes. Yes.
How's that fit in with this kind of scenario under which the labour market might be loose enough in order to facilitate a sustainable downturn in underlying inflation?
Well, the labor market really isn't looking that loose right now. We're still seeing initial jobs claims to be quite low, although some big layoffs in the tech sector may change that picture. Uh, the employers are hiring where they can find qualified workers. Many of them are in smaller companies, which have just been gasping for workers. So, really, the labor market seems to be holding up reasonably well. Uh,
So does this suggest then that, I mean, as certainly as we go into next year, I guess, most parts of the world we expect to see inflation coming down just due to base effects from food and energy we've seen during the course of this year. But does this mean that, really the Feds should be concentrating much more upon what's happening to the core rate, which will be reflecting that much more the likes of what's going in the labour market and in particular wages?
uh, I think they're going to have to keep their eye on the headline because that's really what people react to.
Hmm.
Um, at least in terms of conveying their message about their intentions for monetary policy.
All right, fair enough. And I've got to ask you a little bit about politics. We certainly don't want to make this podcast a bias towards politics, but given the way the shake-up from the midterms appears to be going in the States, obviously we know now that the Democrats have retained the Senate, but it still looks as if the Republicans will get, what I guess, a slim majority in the House. So what sort of implications do you think that might have for fiscal policy and ultimately, in terms of this podcast, hence inflation and Fed policy itself?
Well, I think we're in for a number of budget battles again, and threats of government shutdowns, associated with raising the debt limit. But really, I think it's hard to tell. I mean, U.S. politics, both parties have gotten so obstructionist about things that the activity in the House may feel that they have to counterbalance what's going on in the Senate. But I think that we will see a somewhat more cooperative situation. Um, and the focus on the economy on the inflation and the economy is just so intense right now that I'm not sure they're both going to come up with the same solutions, but I think they're definitely focusing on the same problems.
Right. Last question for me for you then, Terry. December FOMC, how much they're going to raise by?
I think a 50 basis point.
And you're quite comfortable with that?
I am. I mean, we're still hearing a lot of talk from Fed policymakers about raising rates until they get the job done. They've got their first intimations that that's the case with this October Consumer Price Index report, now the October Producer Price Index report. They will have the next personal income report in hand when they meet in mid-December. So if all the inflation reports are pointing in the same direction and telling basically the same story, the level of inflation is still far too high and uncomfortable for too many Americans. So the Fed will continue to act, but I think they can begin to slow the pace of increases now.
Okay, fair enough. Thank you very much for that. Anything else you'd like to put into the pot from your side?
Well, I'm very much anxiously awaiting tomorrow morning's retail sales report here, because that's going to tell us a lot about what consumer spending is going to look like in the third quarter. So that's the thing I'm really keeping an eye on right now.
Okay, thanks, Terry. Tip from the top, retail sales tomorrow. Keep your eyes on it, folks. Right, let's move across the border then to Max, Canada. Headline inflation has come down, quite sharply, from over 8%, remember rightly, in June to slightly under 7% in September. Core rates come down a little bit as well. Tomorrow we'll get the update for October. Is that likely to change the picture of perhaps an easing inflation profile, or there might be some nasty surprises there?
I think the median forecast is just about 7%. So there's going to be an uptick because of the volatile gasoline prices going up and down and up again. And of course, rising mortgage rates and other prices. But looks like if you take a look at the charts, total CPI, as you mentioned, coming down from 8.1 in June to now 6.9. And if you take a look at the some of the core measures that the Bank of Canada is closely monitoring, median is now 4.7 compared to 4.9. So looks like by all measures trending down a bit, but as the governor mentioned recently, it's not really falling down yet. So as Governor Macklem said, they're getting close to the end of the tightening cycle, but their job is not done yet.
Okay, good. I was going to ask you on that. It's kind of following on from what you've been saying. If I can just quote what the governor was saying, I think it was back end of last week. Much of the inflation we're experiencing reflects domestic factors, namely excess demand in the Canadian economy. Our economy is overheated, job vacancies are elevated, and businesses are reporting widespread labour shortages. So I guess, just reading between the lines of that little lot, it kind of suggests that until such time as we get, the removal of the current output gap, they're going to be very cautious about certainly coming out reducing interest rates anyway. Is that the kind of sense you get? So it's not just about looking at the actual inflation numbers themselves, but you've also got to keep an eye on what's happening in terms of both simple demand and supply imbalance.
I think, as the governor mentioned on another occasion, that they have their own new dashboard of a bunch of indicators showing where the labor market is going. And I think one of the key ones is job openings. So they're checking both the real economy and inflation expectations. And as the governor, he has to say, oh, we are so mindful of how painful it is for many Canadians when interest rates are rising. But at the same time, he's saying, if you don't act now, you have to hike more later. So I think now the policy rate is at 3.75. We're looking at terminal rate of either 4, which means another 25 basis points in December, and that's it, or going up to 4.5, which is another 75 total. So it's really now we're really getting into the data dependent phase now.
Okay, and I'll just ask you about this inflation measure as well. I read something the other day, I think it's in the Bank of Canada's the monetary policy report, talking about focusing more upon the 3-monthly change in the core rate of inflation, rather than looking at the annual rate, as the annual rate effectively involves too much of a lag in terms of using very much historical data. Do you think this hints that perhaps because this 3-monthly change has been coming down rather faster than perhaps the year-on-year rate, that this is going to become increasingly the kind of focal or piece of data they're going to be looking at with regards to setting policy, or is this perhaps just a temporary phenomenon?
I think they've always been looking at various sets of data, including the measure you just mentioned. But I don't think they really want to show their hands, and judging from the governor's surprise moves in the past year, I mean, from the beginning of this year, we can't really read too much into what they say and just focus on one set of data.
Yeah, fair enough. Okay, that's it from me from Canada. Anything else you'd like to put in from Canada?
That's it so far.
Right, in that case, you don't get away with it yet, because I moved to you. Let's go down to Asia now and Japan. Right, before I ask you about inflation, yesterday we got our first look at Japanese third quarter GDP. I was going to say that the UK was the only G7 country to suffer negative growth last quarter, but obviously Japan has just joined it. So how bad was third quarter GDP? Is it something we should be worried about, or perhaps do the components tell a slightly different story?
I didn't really see a huge downturn from this data. Of course, the headline number down 0.3 quarter, annualized 1.2. But if you take a look at the growth in exports, it's been actually steady. Let's see, about 1.9. That's goods and services. 1.9 on the quarter, and previously 1.8. It's actually been picking up from minus 0.6 in July, September last year to 0.6, 1.1, 1.8. Now it's 1.9. What really killed the net exports is the surge in imports, 5.2. Of course, the cheap yen is making already high, import costs even higher. And also the economic minister mentioned yesterday that there's a temporary spike in service payments to other countries in that quarter. So if you take a look at the whole picture, you see the consumption actually managed to grow from the previous quarter, and business investment a little slower than expected, but still 1.5 after 2.4. So I don't see a huge weakness in it. And then I think the general expectation is a bounce back in October, December. And if you take a look at the private sector expectations, probably for the whole quarter 2022, sorry, not quarter, the fiscal year 2022, still just under 2% growth, and the following year just about 1%. So if you take a look at the whole fiscal year, I don't think it's a huge slowdown.
Okay, fair enough. Right, if we get back to what we're supposed to be talking about, inflation, then we'll get an update on the October CPI on Thursday. And from the Econoday's consensus forecast, we have 3.7% for the headline CPI year on year. That's up from 3% in September time. So it certainly looks that we're not at the peak in terms of inflation for Japan yet, if that's something to go by. Is that your sense? And is that a number as high as 3.7 or perhaps even more than that going to be a problem for the BOJ?
3.7, it's a spike. And then I think you'll probably peak in December or so. It is because the October is the month, the start of the second half of the fiscal year. So typically in April and October, companies review and usually raise prices. Mm-hmm. And if you take a look at the list, it's from food, beverages, tobacco, cooking oil, almost everything, and takeout food. So it's a bit of a burst, but it seems to be peaking in the early parts of next year, because if you compare the energy and commodities prices year-on-year growth, it will come down later that year. And also the government is putting together a package, and they're promising to give financial support to many of the households so that they can cut the payments to utilities. So that will also push down CPI next fiscal year. And if you take a look at the Bank of Japan's latest quarterly median outlook by the 9 members of the board, this year 2.9% core CPI, that's excluding fresh food, including energy. And 23 is 1.6, 24 is also 1.6, and that's not too different than what the private economists are saying, 2.7 this fiscal year, down to 1.5, and 24 is 1%, even close to zero. So if they're not wrong, that means the Bank of Japan doesn't really need to do anything until much later, and maybe in the middle of towards the end of next fiscal year, they might consider raising the target from minus 0.1 on the short end to closer to zero, and maybe long end target from zero to a little bit above zero.
Okay, so still no change from BOJ over the foreseeable future. Pretty well then. I'll ask you a last question, Max, and God forbid I want to raise this, but with regards to COVID, there appear to have been some reports coming out that there's yet another COVID wave impacting Japan now. I think one of the television stations were talking about the possibility of daily COVID infections topping 100,000 as soon as today or tomorrow it might have been. So we're going back to pretty big numbers in terms of COVID here. Is there any concern amongst the government, or indeed do your own sense that this could have some implications for the way the real economies are going to perform during the rest of this quarter?
Well, judging from what the medical experts, people sitting on the government's board, saying, they are basically in the eighth wave of the pandemic. So it is happening, and they are now plunging into the flu cold season as the temperatures decline probably in December. So that's probably already reflected in the cabinet office's monthly survey, Japan Economy Watch survey. Present condition index is rebounding, picking up, but for the future, the index is down for the second month in a row. So definitely high prices aggravated by the cheap yen, plus the risk of a even bigger spike in new COVID cases. I think what happened was I visited there in October, and I could see people are still wearing a mask while the prime minister is saying we're reopening, so you don't really have to wear one outside the closed spaces. But people are still being careful. And but then during the summer, it was the first summer without strict masking, face covering mandate or social distancing. So people did travel, went out, and that led to the worst spike since the beginning of the COVID pandemic. So it's almost like on and off, and the GDP growth or contraction reflects. Well, one of the reasons is the pandemic high and lows, and so that's going to affect the economic activity, obviously.
Okay, one to keep an eye on, I guess, sadly. Okay, anything else from your side, Max?
Yes, on the political side, I was expecting to see a short-term administration. I mean, the current prime minister, I thought wouldn't last that long, but he is in trouble. The approval ratings are falling, largely because of the close tie between the ruling party politicians for years, decades, with the Unification Church. Now they're trying to probably make it illegal, the activity. But it's also, I think the voters don't know where the prime minister wants to take the economy to. He was talking about new capitalism, but what he's been doing is more on the defensive, trying to cope with COVID spikes and just giving subsidies to keep the retail gasoline prices down. But that goes against his vision of promoting more investment in greener energy sources, or more importantly, maybe digitizing the private sector and the government functions. So I think there's only a low expectation for the current administration to cope with both short-term, long-term problems.
Okay, thanks for that, Max. Excellent as always. So let's go down to Bron then, and China, where I guess, as far as investors are concerned anyway, inflation still seems to be taking a back seat in policy decisions behind COVID. Before we get to zero COVID policies and the like, Bron, I mean, CPI inflation in October only 2.1% after 2.8 in September. I mean, have we already seen the top, as low as it might be?
Well, I mean, let's just step away from the headline number, because that sort of bounces around a little bit, depending on pork prices and vegetable prices. If you look at the core number, I've got it right in front of me right here. It's been trending lower really since the start of the year. It's gone from around 1%, 0.9% at the start of the year, down to 0.8% mid-year, and now sort of bumping around 0.6%. So, clearly the underlying price pressures in China are very subdued at the moment, and I think that's mainly reflecting the impact of all these zero COVID policies.
Right, so let's get on to a bit about zero COVID then. The government's just come out with announced some steps to, well, I guess, open up at least a little bit, probably the most since the pandemic actually began, with a number of new rules making it easier to travel and things like that. So do you think this is the start of a broader reopening of the economy, or is this just the first tentative steps, which at the end of the day probably won't achieve a great deal?
It could be both of those things, I guess. It is tentative and won't maybe achieve too much in the short term. But if public health conditions do improve, substantially over the next 3 to 6 months, then hopefully they will be emboldened to, release those restrictions, more quickly, and then we can get the economy moving again. So, I think they've made it very clear that they're being very cautious, and they want to get on top of this, and they're probably taking an approach that you're not really seeing in too many other countries. But touch wood, we will see the public health conditions get under control, and they'll be able to release those shackles.
Do you think, it may be unfair because perhaps it's too politically biased, but do you think the government is actually responding to, well, perhaps public pressure and even market pressure now for an easing of these rules? Because we saw, well, at the beginning of this month, wasn't it? We saw a really big rally in Chinese stocks coming through when there was this report which surfaced suggesting that the Communist Party was setting up a committee to oversee the withdrawal of a COVID zero policy, and Chinese stocks suddenly went through the roof. Do you think they're actually looking at that and thinking, well, perhaps we've been doing this for long enough now, we actually need to do something to ease these rules because zero COVID simply isn't working? Or is that, given we've got the ongoing Prime Minister in situ, is simply not an issue?
I think that they've got to be responding to pressure. I mean, obviously, the political system in China doesn't allow for direct pressure to be sort of public and very critical of what the government's doing. But I'm sure behind the scenes, there's all sorts of approaches being made to the senior leadership from important people in the industry and around the country saying, come on, guys, we really need to do something here. It might be opaque, very opaque, but I'm sure it's happening. And the people, the top people in Beijing have to try and take those factors into consideration. As I said, hopefully they'll be able to do that soon.
I guess it's going to be one of the interesting factors for global inflation as well, because if we do get something which really gets the Chinese economy going again, demand for commodities and everything else presumably could actually be one of those factors pushing inflation higher again. Anything else you want to? Sorry, yeah.
But working against that, hopefully it will ease some of these supply side pressures. If we get all the factories in China working at full steam again, and get things moving, get the ports operating smoothly, then hopefully that could help inflation pressures right across the
point. Swings and roundabouts. Anything else on China?
No, I mean we had the latest set of numbers earlier this week, and they just sort of showed ongoing sort of subdued conditions in industrial production, retail sales, fixed asset investment, and that's pretty much in line with what we've been seeing from the PMI reports as well, and just showing that impact of those public health restrictions.
Okay, let's move across to your immediate part of the world then. Australia. Now, if I remember rightly, I think the RBA were talking about a fourth quarter inflation peak of around about 8% or so. So that's a bit higher than we are at the moment, kind of suggesting that we're not at the peak in terms of inflation yet. But what's the general sense about how inflation is going to perform in Australia over the next year or so?
Yeah, the RBA is still, pushing the line that we're going to see a peak round about now in the current quarter, and then start trending down in the new year. But they've still got a very gradual, slow, reductions in inflation, and the forecast still is 2 years from now we're only just going to get to the top of their 2 to 3% inflation range, and that's even factoring in all the policy rate increases that we've seen since May. So it's not really a forecast that they'd be comfortable with, this idea that we're still going to have another 2 years of inflation above target. And it's very uncomfortable for them, obviously, and we've sort of seen that in some of their recent communications, trying to give a bit of a mea culpa for some of the policy errors that they're, I think, acknowledging that have been made.
Yeah, I was going to ask you that. I noticed there's an interesting piece that I think you mentioned it in our calendar about the RBA talking about some of the issues with forward guidance and the problems of using a combination of state-based and time-based factors and actually putting the forward guidance together. With regards to that, I mean, do you think now, as far as the RBA is concerned, forward guidance has its time, or do you think they're still sufficiently flexible, but if conditions are right, they'll bring it back again?
Yeah, I mean that's the topic of the review that they've just published. We've briefly mentioned it on our calendar, but you could also go to the RBA website and see just the full report, and it's interesting reading. Basically they're saying that we're going to go back to the way we did things before the pandemic, which was more of a qualitative, sort of very conditional and sometimes a little bit vague references to what they think the policy outlook was like. They made the decision once we got to the pandemic that it would be better to give more clarity, to be more explicit in what they are expecting. They thought that would help perhaps settle things down a little bit, but it seems like they've been burnt by that experience, because what we had was all through 2021 the RBA was saying that inflation was going to be okay, and that they would not have to raise policy rates until 2024. And so a lot of people obviously went out and got mortgages and made decisions based on this guidance from the RBA that policy rates are going to be stuck at 0.10% until for another 2 years. And then of course we've seen that that's not what happened. Inflation spiked and they started hiking pretty aggressively back in May, and that's caused a lot of criticism of the RBA. So they've sort of been burnt by that, and they're thinking, okay, well, going forward, we'll return to the more vague, less explicit guidance for where we think policy is going to go.
Less explicit equals greater flexibility. Never a bad thing when you're a monetary policy maker. Right. Let me shift across a bit to New Zealand then. As we talked about, or you've certainly talked about length in previous podcasts, the Kiwis have been amongst the most aggressive of the tightening central banks amongst the OECD group. What's inflation happening? How's inflation going in New Zealand at the moment? Is there any sign that we might be near the peak there yet?
Yeah, maybe. I mean, we had if you want to be very technical, it went down from 7.3% to 7.2% last quarter. So I guess you could call that a peak, but it's obviously still pretty elevated, and it might still take a while for it to get down back to sort of more acceptable levels. So I don't think the RBNZ is through with its policy tightening measures. I think the way to it's likely that we'll see some more rate increases going forward. But I mean, if we obviously see things turn around in the major global economies with inflation, and see continued positive trends in some of those inflation levels in other markets, then hopefully that would also flow through to the New Zealand inflation rate, and it will get back much closer to where the RBNZ would like it to be.
Okay, I've seen some speculation saying that there might be as much as a 75 basis point hike from the RBNZ in December, and I guess that has a large part to do with what appears to be a decent recovery in the service sector with hopefully the end of COVID. Do you think 75 basis points is on the cards, or is that being too aggressive?
I mean, I would think we're still a few weeks away from it, aren't we? I'd probably think 50 is more likely, but you can't rule it out. Obviously, they are prepared to push the envelope sometimes at the RBNZ, and I'm sure if they think that that's what's required to really demonstrate to the public that they're serious and that they want inflation expectations lower, I don't think they'd shy away from doing that. But at the moment, I still think 50 is probably one of the more likely.
Okay, fair enough. In terms of the rest of your region, general inflation trends there, are we close to peak, do you think? Is there scope now for some deceleration, or is still some way to go?
The trend is still higher. If you look at the core inflation rates, countries like Korea and South Korea and Singapore. But over the last 3 or 4 months, the rate of acceleration has definitely slowed down. So hopefully that's a positive sign. And we have seen obviously significant tightening in most of those countries. So I think it's just going to continue to reflect global trends to a large extent. But the policy tightening that's already being put in place should also, you would think, start to have an impact on inflation rates over, as we move into 2023.
Fair point. And that's certainly one of the truer points, I think, which perhaps a number of central banks are starting to allude towards now, given the amount of tightening we've seen coming out from various central banks around the world. And it takes time for those increases in interest rates to actually feed through into economic activity and inflation. And of course, the risk is if you don't give it a chance to do just that, you end up tightening far too far. Okay, anything else from your part of the world, Brian?
No, I think that's just the main point. Over the next 3 to 6 months, I think you will see the major central banks really deliberating hard about just how aggressive they need to be. Looking forward at where they think inflation is going to trend over the course of 2023.
Okay, lovely. Thanks for that. Right, let's go across to my part of the world and round off with Europe. Eurozone then, in fact, Europe in general, I guess there's a number of central banks over here who are somewhat desperate to see inflation top out given the state of the European economy. As far as the Eurozone itself goes, the numbers aren't looking too clever currently. The October inflation figure came in at 10.7% on an annual basis. That was up from 9.9% in September. The core rate up at 5% after 4.8%. Both figures, yet again, new record highs. Now, I guess the good news is that as far away from the 2% inflation target that those figures might be, there are at least some indications we're getting close to the peak over here. PMI surveys and other business surveys suggest that input cost inflation is beginning to ease a little bit now. We don't have a lot on wage growth, but I think most of the European central bankers are intimating there haven't been too many signs so far of second round effects of higher inflation coming through on wages. So there's some hope there as well. Nonetheless, look at the likes of the PPI. Terry was mentioning that we had a soft, at least relatively soft PPI out the States earlier on today. Well, as far as Eurozone is concerned, they're still running at ridiculously high rates. Some annual growth in the Eurozone PPI currently stands at just under 42%. So that's 42%. So it's miles above where the current inflation rate stands. So really does suggest there's still significant amount of pipeline pressure coming out of the manufacturing sector. Nonetheless, overall, the bigger picture does seem to suggest we're getting close to the top. And just on a technical basis, in terms of November, we saw a very large increase in the inflation index, the level of prices in November last year, and that certainly increases the chances we could see some kind of decline coming through when we get this month's data out in 2022. All that said, most of the commentary coming out of the ECB currently is warning that underlying inflation is still gaining traction. It's becoming more braced, more broad-based, if I can say it, etc., etc. So it still looks very likely that we're going to see another sizable increase in ECB interest rates once we get to the December meeting. They've done 75 basis points at the last couple of gatherings. I think they'd like to do 50 basis points in December, but if the inflation figures continue to accelerate, I think they'll be forced into doing another 75 basis points. And on that front, the latest forecast coming out of the EU Commission, they released them just last week. They're talking about Eurozone inflation this year averaging 8.5% and only slowing to 6.1% in 2023, 2.6% in 2024. So bottom line there, of course, is that even in 2024, inflation is still above target. So the overall impression across the Eurozone is despite generally signs that growth is slowing, and indeed probably a moment odds on a recession in the Eurozone beginning in the current quarter. The labour market, like in so many other parts of the world, remains tight enough that inflation is still more likely to go up than it is to come down, and that's going to keep the trend in interest rates on the way up. UK then, well, we got a UK inflation update tomorrow. That'll be for October, and that's almost guaranteed to be a bad one. We stood at 10% as of September. In October, we'll get the increase in the energy price cap that the regulatory body introduces over here. That in itself is going to add a significant amount to inflation. So the consensus is around about 10.6, 10.7% or so. So that's going to maintain pressure on the Bank of England to raise interest rates further. That said, there is at least also reason for hoping, if not supposing, that inflation in the UK now may also be relatively close to its peak, just on a technical basis. If all prices can stay at current levels, then we should start to see inflation coming down next year. But that said, and again, it still comes back to the labour market. UK labour market, despite the fact that all these forecasts are for one of the longest recessions we've ever seen in the UK, labour market remains very tight, and that's being reflected in what's going on in wages. So the data out we had from over here earlier on this morning showed regular wage growth up at 5.7%, and that's a record high since the data were first compiled back in the beginning of, where are we, 2000, I think, if I remember correctly. So anyway, record high suggests that pressures coming from wages remain on the upside, and this, I guess, as I tried to allude to earlier on, is going to be one of the key factors, I think, for a lot of central banks as we go into next year. Even if we do see the commodity markets, and in particular the energy markets, behaving themselves in 2023, that just via base effects will allow headline inflation rates to decline. If we still got wages rising or maintaining very high levels, that's going to keep core inflation high, and that's going to be a big issue, I think, for the central banks as we go forward, and may mean that as markets start to anticipate interest rates coming down, they start to anticipate the rate reductions coming through rather quickly will naturally be the case. The other thing I need to mention, particularly for the UK, as of Thursday, we'll get the long-awaited Thursday autumn statement. This will be an update on the UK's fiscal position after the disastrous mini budget introduced under the previous administration at the back end of September time. There we're expecting to see, well, a whole range of fiscal tightening going through. Basically, we've got a black hole of somewhere in the region of an estimated 35 billion sterling to fill, and there's talk about fiscal tightening of as much as 55 billion or so coming out of the autumn statement, which will be one of the most aggressive we've seen in an awful long time, which of course will weigh further on the UK economy, but might ultimately mean that the Bank of England doesn't have to tighten it as much as some people are expecting them to. And indeed, we've had some comments coming out from the central bank, really ever since the meeting at the beginning of this month, intimating they weren't happy with the way financial markets were pricing in bank rate over the coming next couple of years or so, regarding the implicit forecast from financial markets as being much too aggressive. So it could well be that we don't see interest rates going up as much as people anticipate over the next year or so, but certainly it seems pretty well given that we will see rates having to go up again at the December MPC meeting, simply because inflation is still too high, and for the time being at least, it is still going up. Okay then, well, that's probably pretty well it, I guess, as far as today is concerned. In summary, I guess we can say it's pretty well a mixed global picture, but in general, if inflation hasn't already peaked, it probably isn't too far away from doing so. In any event, base effects should contribute towards slowing price gains as pretty well everywhere as we go through 2023. As mentioned, do keep an eye on core inflation, which, unless wages behave themselves, could prove rather more sticky. In any event, best way to keep up to date with wages and all the other economic data and events is, of course, via Econoday's global economic calendar. So do take a look. And with that, on behalf of Brian, Terry, Max, and me, thanks as always for listening. We hope you can join us next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. the Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.